of course, we want to get a check of the market. This is the final trading day of the week. We mentioned that hot inflation data, and it's definitely weighing on markets in the first minute of trading here. Taking a look, the Dow off about 450 points to kick off this Friday, on track for a lower week. Joining me is Clayton Triick, head of portfolio management at Angel Oak Capital Advisors. Clayton, so good to see you again. Thanks so much for being here.
Yeah, thanks for having me again. Great to see you, Caroline.
So I know you take a more of a fixed income view, but I do want to get your take on the stock market here this morning. How would you describe the market environment right now? Not just the weakness that we're seeing today, but really the volatility and the rotation that we've been seeing so far in 2026.
Yeah, we, as you mentioned, we really specialize in fixed income and alternative investments, but we're obviously watching the equity market, especially the U.S. equity market. Expectations for this year, we heard a lot of comments from other strategists around potential turbulence. I don't think we have really had that much of an aggressive call, but we thought volatility would definitely pick up this year. You've seen so much PE expansion, especially in tech, and then we expected a more broadening out of the U.S. equity market, so a little bit more diversification going on. So we're not too surprised at the equity moves we've seen, particularly in February, and since February has been a choppy month, not surprised to see the last day of this month moving a little bit lower ahead of the open. So there's a lot of questions that are coming out, really around the technology side. And this morning we got PPI, which was a little hot, which is going to continue to keep that debate on Fed cuts alive and well as we head to a potential new chair in Q2.
Okay, yes, I want to dig into PPI and what it means for the Fed in just a second, but you mentioned the rotation that we've been seeing out of tech into other areas of the market, things like energy, materials, industrials, even consumer staples. What are we seeing in terms of that money going into bonds, and is now the right time for investors to be thinking about fixed income opportunities?
Yeah, absolutely. I mean, investors for a decade were really complaining that yields were so low. In 2022, we ripped the Band-Aid off, and yields have really been attractive across really all areas of U.S. fixed income, right? So treasuries at positive real rates, we're still there today. Agency mortgages, IG corporates, all areas have actually looked pretty attractive on an all-in yield basis. If you think over the last 40 years, U.S. fixed income relative to equities sticks out. So, while investors have different goals long-term on when they're looking to, invest and create wealth, fixed income, relative to equities has looked pretty attractive. So we've been saying investors should be a little more overweight bonds going into 2026. So we like U.S. fixed income right now. We're a little more selective going into this year than we were the last couple of years because you've seen such a big rally in areas like U.S. credit on the corporate side, but you've seen more of a lag in the mortgage and asset-backed security side. So we've making some pretty strong rotations heading into this year to take advantage of that. But broadly speaking, U.S. fixed income looks really good, and investors looking for income should be more overweight fixed income than they usually are, given where equity valuations are today.
Okay, you mentioned being more selective. Dig in a little bit more about where those opportunities are, especially given the hotter than expected inflation data that we got this morning and what that could mean for the Fed in terms of potentially having to be on hold versus further cutting.
Yeah, so investors need to focus on kind of two main areas to take advantage, or kind of two main themes. One being protection of principal. And right now, the housing market we still think is in really good shape from a credit perspective. There are a lot of bonds within agency and non-agency mortgage-backed securities that should hold up really, really well in both an economy that reaccelerates here and also an economy that potentially could enter recession potentially next year. So we think mortgage-backed bonds should hold up over both scenarios. And so that's where that really sticks out. We're a little more cautious on the corporate credit side. You've seen a lot more volatility within private credit, especially a lot of the news that's come out even yesterday within MFS. So there's still a lot of concerns on the credit side, even if yields are quite attractive. We much prefer non-agency mortgages, especially bonds trading at a discount that were issued a couple of years ago. So those are extremely attractive, and we've been focusing more on that heading into this year.
All right, I'm getting the wrap signal, so you have to just give me a number here. How many rate cuts this year, if any?
We're thinking more like 3. It's gotten really quiet from a FOMC perspective, right? Seems like we're definitely heading into the Warsh expectations for the end of the second quarter. And so we think the market could be very surprised here and could get more of like 3 or more cuts really in the second half of this year as we get to a 2 handle on Fed funds. That's really good for the U.S. economy and really, really good for bonds. And investors are really not pricing that now.
All right, I have follow-ups, but we ran out of time, so you'll have to come back and tell me why 3. Clayton Triick, Head of Portfolio Management at Angel Oak Capital Advisors. Thanks so much.
Looking forward to it. Thank you.